There is a number inside the banking system that quietly changes everything, and almost nobody knows it exists. Not because it's hidden in some government document, not because you need a finance degree to understand it, but because banks have spent decades making sure you never think to ask about it. That number is $25,000, and the moment your savings cross that line, the rules of banking change completely in your favor. But here's what's wild. Most people who actually reach $25,000 don't even realize what just happened. They save up, feel good, then spend it on a down payment or a new car, and without knowing it, they just handed back the most powerful financial tool they'd ever held. The system didn't take it from them. They gave it back voluntarily. So today we're breaking down what the $25,000 rule is, what changes when you cross it, why banks are counting on you not knowing about it, and how you can use it to start paying less and keeping more. Let's get into it. Before we go any further, this is not a loophole. What I'm about to walk you through is how the banking system already works. It's just that this part is designed for people who already know about it. And if you don't, you quietly pay for it your entire life without ever realizing there was another option. Banking is a business with different pricing tiers based on how valuable you are as a customer. The problem is, those tiers are invisible. No sign on the wall, no page on the website explaining that two people sitting in the same branch, opening the same type of account, can end up on completely different terms. And the threshold where things shift across lending, fees, savings rates, and your ability to negotiate sits right at $25,000 in liquid, accessible savings. The first thing that changes is how lenders assess your risk. When you apply for financing, the institution runs your profile through a risk model. Most people think their credit score is the master key. It matters. But what banks rarely tell you is that your liquid savings carry enormous weight in those models too. Someone with $25,000 in accessible savings can absorb a financial shock, a job loss, a medical bill, an unexpected expense. They have runway. That runway makes them far less likely to miss a payment, even compared to someone with an identical credit score, but almost nothing saved. When your liquidity crosses that threshold, your risk classification shifts, and that shift directly affects the rate you're offered. On a significant loan, even a 2-point rate difference is thousands of dollars over the life of that loan. Not because you negotiated harder, just because of what your savings balance said about your stability. The second shift is how fees are applied. Retail banking makes meaningful revenue from low balance account holders. Monthly maintenance fees, transfer fees, out-of-network charges, these are not random. They are structurally targeted at accounts with limited alternatives and limited leverage. If you've ever paid $15 a month just to have a checking account, that wasn't a service charge. That was the bank pricing your lack of options. At $25,000, most major institutions move you into a preferred tier. Maintenance fees disappear, common transaction fees are waived, out-of-network ATM charges get reimbursed. The entire fee structure looks almost nothing like the standard tier. And the bank will not tell you this tier exists when you open your account. They will not nudge you toward it as your balance grows. You have to claim it, because the moment you do, those fees stop going to them and stay with you. And that alone can be hundreds of dollars a year quietly returned to your pocket. The third shift is what your money actually earns. Standard savings accounts at major banks pay close to nothing, and that's intentional. When your balance is small, the gap between a bad rate and a good one isn't worth the hassle of switching. Banks count on that inertia. They know that $2,000 at 0.05% earns you almost nothing, and that's such a small number you probably never even check it. But at $25,000, the math flips completely. The difference between a standard savings rate and a high-yield account, or a government-backed money market fund, can exceed $1,000 a year on the same money, doing nothing different, just sitting there, working harder. And banks know that once customers do this math, they start asking questions and looking around, which is exactly why this is when you suddenly start getting special offers and exclusive rate promotions from your bank. Not as a reward, as a retention play. They're trying to catch you before you realize you've outgrown them. The fourth shift is your negotiating position. And it's the most underestimated of all. At $25,000, you become what banks internally flag as a flight risk. That sounds negative, but it's entirely in your favor. It means the branch knows that if they don't treat you well, You have somewhere else to go, and your departure affects their deposit numbers. A fee reversal, a better rate, a faster resolution to a dispute. These conversations go very differently depending on your balance. Not because anyone is making a moral judgment about you, but because the system tells them what you're worth to the branch, and their incentives are tied to keeping you. At $25,000, you're a high-value account. That status is yours to use, but only if you know you have it. Here's the painful irony. The $25,000 threshold is where your financial leverage peaks, and it's also exactly when most people spend the money. You've been saving for years, you finally hit the number, and it feels like enough. Enough for a down payment, a car, a renovation, and so you spend it, usually on something that immediately comes with brand new monthly obligations. Now you're below $25,000 again, carrying more debt at rates that were partly set based on your pre-purchase savings balance. You voluntarily moved yourself back into the high-cost category at the exact moment you took on your largest financial commitment. You gave up the leverage, the exact moment you needed it most. This is not a mistake people make because they're bad with money. It's a mistake people make because nobody explained the rules. The $25,000 balance is not the finish line. It's the starting line. It's the point where the system finally starts working for you instead of against you. Think of it less like a pile of cash and more like a key. The key doesn't do anything sitting in your pocket, but it opens doors that were locked to you before. Reach $25,000. Hold it long enough for the shifts to take effect. Lower your costs, lock in better rates, then make your larger financial moves from a stronger position. The order matters enormously. You don't need to wait until you hit $25,000 to start. First, run a fee audit. Pull up your last 3 statements and add up every fee you paid. If it's more than 0, move to a high-yield online bank or credit union that doesn't charge fees for basic banking. That money goes into your target instead. Second, close the yield gap. Check what your savings are actually earning right now. If it's under 3 or 4%, you're paying a loyalty tax for staying somewhere out of habit rather than strategy. Move your savings to where the market rate is and let it compound while you build. Third, declare your liquidity. Next time you apply for financing, tell the loan officer what you have in liquid savings and ask directly how it affects your rate tier. Some won't volunteer this. You have to surface it. And if they act like it doesn't matter, take your application somewhere with a more current underwriting model. Fourth, hold the line. When you hit $25,000, resist the urge to spend it. Give yourself at least 3 to 6 months where that balance stays intact. Use that window to renegotiate your existing costs, ask about tier upgrades, and let the balance do the work before you put it to work elsewhere. The $25,000 rule is not a secret law. It's just the point where the math flips, where you stop being a source of fee revenue and start being someone the bank has to compete for. Most people spend their entire financial lives just below that line, not because they couldn't reach it, but because nobody told them what was waiting on the other side. Now you know. The next move is yours. And if you want to go deeper, the exact account structure, how to stack your savings rate while you build, and what to do the week you actually hit the number, that's coming in the next video. Don't miss it.